Multi-time frame market structure, what is it? Well, multi-time frame analysis is where we are analyzing charts across multiple time frames together. So it kind of says it in the name really, right? So let's say you're looking at the weekly chart. On that chart, one of those candlesticks, so one weekly candlestick, that will contain the price action of 5 daily candlesticks. Obviously the cryptocurrency market, right, that's open for 7 days a week. So a weekly candle in crypto, that would obviously contain 7 daily candles. But fortunately the FX market is closed on the weekends, so we can actually have a break. So obviously the weekly candle in the FX market only contains the price action of 5 days. 5 daily candlesticks are within that weekly candle, right? And then you've got 34-hour candlesticks within that weekly candle and 120 one-hour candlesticks. And then that one daily candle is made up of 24 hours worth of price action, so on and so forth. So you can clearly see that, as you start from those higher time frames and you work your way down and down, going lower it's going to give you a lot more price action to work with. It's going to give you more information, and it's also going to give you more confirmation. So that is going to allow us to be extremely accurate with our entry points and analysis, but also whilst making sure that we are trading with the overall bias and we're trading with the dominant trend of the higher time frames on our side. So time is power. Really, the longer that a setup has to marinate, the more powerful and delicious the move will be. The reason why is essentially the more orders and liquidity that have been stacked over time are there to then fuel the move. So for this reason, analysis on the higher time frames always take precedence over analysis on the lower time frames. So the monthly time frame is a lot more significant than the weekly time frame, right? And so on, all the way down to the minutes and the seconds time frames. So this is why we always take a top-down approach. We always start our analysis on the higher time frames in order to develop our bias, and then we work our way down and down and down to refine and to increase our timing accuracy. So the other thing as well is, right, the higher time frames are not necessarily a specific time frame, but it's just any time frame that is higher than the one that you are currently looking at. So obviously the same goes for the lower time frames. It's going to be different for every trader, depending on their own unique trading style in terms of what time frames they actually use and look at on a consistent basis. Now, the reason that we use candlestick charts in our analysis is due to their unique ability to condense a vast amount of information into a small, neat, and manageable graphic display. So, you can think of candles representing the tip of an iceberg. Now, whilst they provide an excellent sign of what's ahead, there is a lot more that lurks beneath the surface. For the most part, the exposed tip of an iceberg is enough for the captain of the ship to, recognize the need that maybe we need to steer around it. But every now and then, an iceberg will remain fully submerged and provide no indication of its existence above the surface. So without us actually peering below the water, we're going to likely steer our ship straight into it. So kind of a horrible analogy there, but essentially in trading, using a lower time frame is the same as peering below the surface. The more time that you spend in front of your charts, the more that you will realize that all of the time frames are very intimately connected to each other. So when price is trending, in this case a bullish trend, we know that price moves up, it then pulls back to form a higher low, and it breaks structure to the upside to form a higher high, and so on. Hopefully you should be very familiar with this by now. Each of these movements up and down are called runs. So price impulses to the upside, and then it corrects back. Then it impulses again to the upside, and then it retraces back, right? Depending on whatever terminology you want to use, all of those moves up and then back to the downside, those individually are called runs, and they make the heartbeat of the market. Now, collectively, all of those runs together make up what we then call a trend. Now, are you ready for what is the major key in unlocking the secrets to understanding and harnessing the extreme power of multi-time frame analysis? You are? Fantastic. Well, the secret sauce is that a run on a higher time frame is a trend on a lower time frame. So a run on a higher time frame is a trend on a lower time frame. Sounds pretty simple, right? But when you get your head around this and when you fully understand it on the charts, that is when the power of multi-time frame analysis will really start to click, and you will massively increase both your strike rate and your risk reward. And that is the holy grail in trading, right? Increasing both of those simultaneously. So what we have here is a line diagram to essentially illustrate multi-time frame market structure, right? It says it there in the title, but it's essentially trying to show the relationship between a higher time frame and a lower time frame. So we're going to try and keep it reasonably simple at the start with just thinking about and looking at two time frames. Now, whilst we initially look at multi-time frame market structure, I know up until this point during the course, hopefully if you've watched it in order, we've been looking at the three different types of structure, right? So we've been looking at swing, we've been looking at internal, and we've been looking at fractal. Now, what I want you to do for the moment is just to kind of forget about all of that, or maybe just think about swing structure on its own and just think that there's only one type of structure, okay? But with that one type of structure, we're now going to look at that across multiple timeframes, okay? So we're bringing in sort of, that three-dimensional shape. So let's just think about swing structure and let's think about two timeframes. So initially, we're going to think about the higher time frame, okay? So one time frame, which is this thick black line. So as we know, we have bullish market structure initially, where price impulses to the upside, then we correct back to form that higher low, we break structure to the upside to form that higher high, pull back to form a higher low, higher high, and then we break structure to the downside. At that moment, that higher time frame trend is then bearish, right? We take out the strong low to form a lower low. At that point, this then becomes a strong high, right? Because it's broken the low. So now this becomes our strong swing high, and this becomes our weak low. So we're trading in between this range. Price then has a swing pullback, okay? And then it breaks to the downside to take out that weak low to form a lower low. However, in the end, price then breaks to the upside to form a swing higher high, pulls back, and then continues that bullish trend, okay? So we understand that, basic market structure from one time frame. Now let's bring in a lower time frame. So we're going to look at the thin gray line, right? Now, remember what I said the key to multi-time frame market structure is, and that is a run on a higher time frame is a trend on a lower time frame. And this is exactly what it means, right? So a run on a higher time frame is a trend on a lower time frame. This impulse to the upside, that is a run on the higher time frame. But on a lower time frame, what do we see? Higher high, higher low, higher high, higher low, higher high. So that run on the higher time frame is a trend on the lower time frame. So maybe if it helps you to visualize it, let's say the higher time frame in this case is the 4-hour chart and the lower time frame is the M15. Well, we can see that that one impulsive leg up on the 4-hour chart is made up of a trend on the M15. Now, when we get that 4-hour pullback, that higher time frame pullback, what happens to the lower time frame structure? Well, in this case, the lower time frame structure switches bearish, right? Because we get a higher high, higher low, higher high. And then as the higher time frame pulls back, the lower time frame then switches bearish as it makes a lower low, right? It breaks that low to make a lower low. So then we make a lower high, right? This strong lower time frame high is strong because it took out the low. Price pulls back and doesn't break it. It respects it. And then price continues the bearish trend on the lower time frame. So we get another lower low. But what we have to realize is because the higher time frame, it's only a pullback, right? Because the higher time frame is bullish. We know it made a higher high. It's simply just pulling back, that we have to understand that the lower time frame only switched bearish to facilitate that higher time frame pullback. So when that higher time frame pullback is complete and the 4-hour chart, for instance, wants to form that higher low, what is going to happen to the lower time frame structure? Well, it's going to shift bullish again, right? So we come down, that 4-hour pullback is now finished. So now the lower time frames are ready to switch bullish again. And it breaks that lower high to form a higher high, okay? And that's the relationship between the lower time frames and the higher time frames. Essentially, in a nutshell, in its most simplest form, we'll have them both aligned where they are both making higher highs and higher lows, or the lower time frame is bullish whilst the higher time frame is moving to the upside. Then when the higher time frame has a pullback, the lower time frame structure will shift bearish to facilitate that pullback. But when that pullback is complete and the higher low is in place, the lower time frame structure will then switch bullish again. And then the exact same process repeats, right? We get the next higher time frame bullish leg to the upside. The lower time frame is then bullish. But then at some point, that higher time frame is going to pull back. Why? Well, after a break of structure, what do we expect? We expect to pull back on that time frame. So at that point, when we get that break of structure to the upside, this becomes a new swing low. Okay, we wait for price to pull back to know where the new swing high is. And at that point, what can help, as you can probably now see, what is going to help give us an indication that the higher time frame is pulling back? Well, on a lower time frame, we'll see that switch bearish, right? Let's say the M15 switches bearish to facilitate the 4-hour pullback. Okay, now we're pulling back. We expect price will not break this 4-hour low because it's a strong low. And then when we're trying to anticipate where that 4-hour higher low may form, when is this pullback going to finish? We can let the lower time frames help guide us, and we can see, okay, now the lower time frame has switched bullish again. the high low is now likely in place, not a guarantee, but likely. Because remember, we only know where the high low is once we actually get that break of structure. But when that lower time frame shifts bullish, that gives us a very good indication that that high low may now be forming. And then when it pulls back, we can look to try and catch this long to target the week high and potentially beyond. Okay. And then again, we get another break of structure to the upside. This then becomes our new strong low. The lower time frame then switches bearish to facilitate that higher time frame pullback. And the expectation would be that this strong low would hold, right? So we could look to buy from within here. Now, if you want to wait for a bit more confirmation, because obviously you could jump in here straight away and buy at this strong low, but maybe for whatever reason, you think we might be about to switch bearish. Instead of getting long straight away, what could you wait for? You could wait for the lower timeframes to give you confirmation, right? And how would we do that? Well, we would wait for the lower timeframe to switch bullish. We would wait for that lower timeframe high to be broken, and we'd wait for a move like that. And if that happens, then what do we get? We get confirmation, and then we could look to buy this move here, right? To then target to the upside. But as we can see, that doesn't happen. The lower timeframe stays bearish, and then we get the bearish trend change on the higher timeframe where we switch bearish. Okay, so now we've had a bearish boss on the higher timeframe. What do we expect after a break of structure? We expect a pullback on that time frame, right? So we can then look to trade this pullback if we want to. So we can look to get long. But we don't just want to jump in long straight away. What do we want to wait for? For more confirmation. We can wait for the lower time frames to switch bullish. Okay, now we can look to catch that higher low and trade long. But as you can see, although we would be trading in line with the bullish trend on the lower time frame, right? If we bought this higher low, we're trading against the higher time frame trend, because at this point, we've broken structure to the downside. The higher time frames are now bearish. We're trading between this range. This is a strong higher time frame high because it did its job. It broke that low. Okay. So what we're expecting from the higher time frames, or we're only expecting a pullback before it then continues. Okay. So if we wait for the lower time frame structure to shift bullish, that's good. That gives us more confirmation. We can then look to buy this move. But how you can see it's just a quick trade. We're just looking for a quick move because we're playing the higher time frame pullback, right? We're just playing a quick move here. We're not buying here on the lower time frames and trying to target past this high, are we? Because that's a strong high. We know we are simply playing the swing pullback on the higher time frame. So then likewise, when the lower time frames then switch bearish, what does that indicate? Well, it's quite a strong indication that that higher time frame lower high may be in place. And now we can look to trade the lower time frame bearish structure to target the weak low, right? It's just the same thing again and again and again. The lower time frames essentially switch trends to facilitate those swing pullbacks and then to continue the move. So then the lower time frame stays bearish until it then switches bullish, because after a higher time frame break of structure, what do we expect? We expect a swing pullback. Now in this case, we would have expected that higher time frame high to be strong and for it to be respected, but that's not always going to happen. And it ends up switching bullish. And the lower time frames, you see how they never switch bearish here? So that gave us an indication that that was likely going to happen, right? Because they never switch bearish. And then we come up and then we expect a swing pullback. So the M15 or the lower time frame switches bearish, right? And then so on and so forth. So that's essentially multi-time frame analysis in a nutshell. Hopefully that makes sense. And if it does make sense, it can seem quite simple now, but of course we can, it can get a bit confusing in the live markets where price action can be a little bit more messy. We can be looking at more than 2 time frames. And then when you throw in 3 types of structure into the mix, it can obviously get a little bit confusing. So we're going to try and take it slow. Just think about swing structure initially and just think about sort of 2 time frames. And that can really help you to kind of get your head around it initially. But really nailing multi-time frame market structure is going to be the key to, I would say, one, whether or not you are going to be consistently profitable. And if you do reach that stage, then it will really depend on really how profitable you are. Like, in my humble opinion, this is the key to everything. If you really, really, truly and deeply understand multi-time frame market structure, everything else will fall in place from there. You are 80 to 90% of the way there. Overlaying supply and demand, liquidity and entries and management and everything else we'll look at, they just help us. But if you can get this, you will be on the right side of the market far more often than not. And you will also know how to manage your expectations of how far price is likely to go, right? Again, prime example of what I was talking about earlier. Let's say we switch bullish here on the lower time frames, let's say the M15. You could buy here and that's a great trade, right? You've done everything right, but you might be targeting all the way up here and past this high. And then you end up taking a loss or a break even, giving all your profits back because you didn't understand what phase of the market we're in. We are in, what phase is it? It's the higher time frame pullback phase. So you want to be a lot more aggressive with your targets, right? And also the higher we get up here, you want to be thinking, okay, there's an increased probability now that swing lower high is forming and we're going to be ready to go. So actually, maybe I don't want to keep buying on the lower time frame because I want to wait for it to shift bearish first. Okay, now that swing lower high may be in place, and now we can look to target the low, right? That's a more high probability trade. So it's all about understanding multi-time frame analysis, understanding the relationship between the higher time frame and the lower time frame, understanding its purpose. Why did the lower time frame switch bullish here? It most likely switched bullish to facilitate that swing pullback. Okay, that's super useful information, right? Now, another thing here as well is I wasn't going to do this, but I'll kind of overlay just to get your mind thinking. A third time frame, right? So imagine the gray line is the M15. Imagine the black line is the 4-hour chart. Well, what would the daily chart look like in this instance? So I'm just going to change this to a different color. Let's use something a bit more bright. Let's go with green, make it thick. Okay, so I'm just going to draw this on and then we'll talk through it. So imagine we have a daily move to the upside, then we have a daily swing pullback, and then we have another daily move to the upside there, okay? So that would be the daily chart. So this is the daily run, right? This is the daily impulsive move to the upside. A run on a higher time frame is a trend on a lower time frame, okay? So that daily green run here to the upside, what is that made up of? It's made up of a 4-hour trend. Higher highs and higher lows on the 4-hour chart, right? Now, when this daily chart, the green line, when it wants to pull back, what is the 4-hour chart most likely going to do? Or at least the lower time frames, they're going to switch bearish to facilitate that swing pullback on the daily chart. And that's what we get, right? We switch bearish, we come down, and we pull back. Now, remember, at this point on the 4-hour chart, this would be a strong 4-hour high, right? Because it did its job, it broke the low. So when price is pulling back up into that high, we can look for shorts, of course, because the trend could continue on the 4-hour chart. But if you understand that the daily is bullish, and we are currently in the daily pullback phase, right? It's just a daily pullback, then you can understand and have that knowledge that the 4-hour chart only switched bearish to facilitate that daily pullback. So if we think, when we use other confluence, that daily high or low may be in place, that the daily pullback is finished, then we can anticipate ahead of time that this might fail. This 4-hour high might fail, and the 4-hour chart may be now ready to switch bullish. Why? Well, because the daily pullback is over, and we're now ready to target that weak daily high to form a daily higher high. Okay? Hopefully I haven't lost you here. Don't worry if I have. Watch this over and over again. It will make sense, right? Now, within all of that, what do we have? Like we just said before, we have the M15 switching trend continuously to facilitate the 4-hour trend. And we could go even lower, right? On the M1, what we're going to have? We're going to have the M1 trend up here. Then the M15 pulls back. The M1's going to switch bearish. Then the M15 is ready for the next leg up. The M1's going to switch bullish, right? And that's what we mean. If you ever hear us say the word fractal, the fractal nature of the market, that is what that means. It's all the same patterns and they happen on every single time frame. The daily, the 4-hour, the 3-hour, the 2-hour, the 15-minute, the 36-minute, the 15-second, the 4-month. It's all the same thing. It's just a way of essentially analyzing data, right? Just across different time frames. Okay? So again, hopefully that makes sense. And then you would have that, as your daily trend. And from within that, I'm not going to confuse you too much here. You would have, just change this to say yellow, you would have a weekly run, right? This would all be one weekly bullish move to the upside. And that weekly run, that yellow line is made up of what? It's made up of a daily trend with higher highs and higher lows within that one weekly move. And that's literally it. When you can get your head around that, bingo, right? You're on to winner. So let's take a look at another annotation. Okay, so you might be sort of familiar with, this sort of annotation from when we were looking at 3 types of structure. But again, for now, I just want you to think of just swing structure, but we're going to be looking at multiple time frames, okay? So we have the thick black line, which is our higher time frame. I put in brackets actual time frames if it helps you just to think about it a little bit more easier. So we've got the 4-hour chart as our higher time frame, the thick black line. We then have this sort of thinner gray line, which is our medium time frame, the M15, and then we have the thin white gray line, light gray line, which is the M1, okay, our lower time frame, right? So you can insert any time frames you want here. You could use your higher time frame as the daily, your medium time frame is the 4-hour chart, and your lower time frame is M15, right? It does not matter. It's because the market is fractal, right, and it all does the same thing. So let's talk about the 4-hour, the M15, and the M1, just because at the time of the recording, that is the main way in which I trade, so it's just a bit easier to talk through, okay? So 4-hour swing structure, the higher time frame, higher high, pulls back to form a higher low, and then we break structure to the upside of one big swing move. So at that point, we know we are bullish, we know we are trading between the 4-hour low and the 4-hour high, right? That is our swing structure. Now, what do we expect after a break of swing structure? We expect a 4-hour swing pullback, okay? Now, let's just imagine now that the M15, we go down on the time frame and we see that the M15 swing structure switches bearish, okay? So this might be like a 4-hour fractal low, it could be a 4-hour internal low. It's not a 4-hour swing low, but it could be fractal or internal. It doesn't really matter. Sometimes it will be one or the other, right, in the live market. you'll see this as we go, okay? But essentially in this instance, what we want you to think about is on the lower time frame, that 4-hour fractal or internal low will most likely be an M15 swing low. Okay, so when we get that 4-hour chalk or 4-hour IBOS, not always, but most likely it will be an M15 swing breaker structure to the downside. Okay, so when we're getting that 4-hour pullback, what happens? Well, the lower time frame switches bearish to facilitate that pullback. Okay, so when the M15, let's say, switches bearish, what can we do? Well, we can look to trade the short. So we're trading pro M15 trend, okay, because M15 is now bearish. So this becomes an M15 strong swing high because it took out the M15 low. Okay, so it's a 4-hour weak high, but a strong M15 high, right? Because it broke M15 structure. So now we can look to trade the short, right? We can play that short. But remember, what is our expectation when we're shorting this? What are we going to target with our management? So let's say we get short here, right? Great trade. Are we going to target past this low down here? Well, you could do, but would that be a smart decision? Well, no, because our expectation is we're just playing the 4-hour pullback. This is a strong 4-hour low because it took the high. So if we short here on the M15, right, we know we're just playing a quick move because we're just playing the pullback, right? So we could target here. We could talk about management later. It's more just about managing your expectations that we're just playing counter 4-hour trend, pro M15 trend. But we are in the 4-hour pullback phase, okay? So we want to be aggressive. Okay, now the lower that we get in this bearish M15 trend, we have to start thinking about now we're in the 4-hour discount, okay? This is the EQ of the 4-hour leg. We're now in the discount. Anywhere within that discount, there's a higher probability that the 4-hour higher low, the swing high low may form, right? And we'll be ready to then go on and continue the 4-hour trend and target that weak 4-hour high, okay? So if you're following that bearish M15 trend, you could be shorting, you could be holding your trade. As we come down into that 4-hour discount, you have to start thinking, okay, at any minute now, the M15 may switch bullish, okay? Now, you could also look for longs from within here, right? Especially as we come down into a nice 4-hour discounted level, et cetera, et cetera. But you may want to wait for a bit more confirmation, okay? Because there's no guarantee the strong low may hold, right? Sometimes it might fail when the trend changes. But let's say you want to wait for a bit more confirmation. Well, you can wait for the M15 to switch bullish. So in this case, it switches bullish. That's very strong indication, not a guarantee, but a very strong indication that the 4-hour higher low may now be forming, right? So the M15 switches bullish. And now we can look to try and catch the M15 pullback, right? To capture that M15 higher low, because now the M15 is aligned bullish with the 4-hour swing structure, right? And now we can look to try and capture this M15 high low to try and target the weak 4-hour high because we have that full structural alignment where the M15 is aligned with the 4-hour chart, right? So again, same concepts. You can put on the premium discount if you wanted to on the M15 leg and wait for price to pull back and capture the M15 high low. Now, when the M15 is pulling back, what will happen on the lower time frame, let's say the M1? Well, in order to facilitate the M15 swing pullback, the lower time frame is going to switch bearish to do that, okay? So again, you could jump in straight away and try and capture the M15 high low, but we can use even more timing and accuracy and confirmation by going down to a lower time frame such as the M1, wait for the M1 to switch bullish, okay, M1 switches bullish, wait for that M1 to pull back, and even that M1 pullback, right? On let's say the 15 second, the M15 second we switch bearish to do that, okay? We're not going to do that, but just think about this now. Now we have full structural alignment. The M1 is bullish, which is confirming the M15 high low. The M15 is bullish, and that M15 switching bullish potentially confirms that 4-hour high low may be forming. And now this becomes a super high probability trade to now try and target that 4-hour high. Okay? So hopefully that makes sense. Watch this as many times as you need. But essentially, it's just a fractal nature of the market, right? 4-hour makes a swing higher high. We're then looking to play that 4-hour swing pullback. The M15 switches bearish to facilitate that swing pullback. Okay, so we can look to trade this. But we know as we get deeper into the 4-hour discount, there's an increased probability that the M15 is going to switch bullish. Why? Well, because that 4-hour high low may be forming, right? We're just playing the swing pullback phase of the higher time frames. So we know at any point the medium time frame in this case is about to switch bullish. Okay, it switches bullish. Now we can start to look for longs to try and target the 4-hour high. But we don't just want to buy straight away. We can wait for the M15 to pull back. What will help us determine when that M15 pullback is finished? Well, we can look for the lower time frame to switch bullish. Lower time frame then switches bullish. Okay, that M15 pullback is now likely finished. And now we can get long with full alignment to target the weak M15 high and potentially all the way up to the 4-hour week high, right? And then we can look to follow those trades up there, right? So that is literally the fractal nature of the market. Now, some of you may have realized that, essentially the 3 types of structure, when we only looked at one time frame, it's the exact same thing. But looking at 3 types of structure essentially allowed you to do multi-time frame analysis without having to go and look at other time frames, right? i.e., we would have your your swing structure as the big black line. Then you'd have your internal structure, shifting bearish, right? And then within that, you can have your fractal structure, right? So yeah, if that's too confusing to think all about that at once, don't worry about it for now. It will make more sense as we go through this and we look at examples on the charts. But yeah, hopefully that makes sense. Again, watch this as many times as you need. So hopefully the penny's starting to drop with that fractal nature of the market, that fractal order flow, where price action, it ultimately forms the candles and the price action on the next highest time frame. So we use the price action on the higher time frames to predict that next phase of the market. So when we say the phase of the market, what do we mean? Well, we mean, are we in the pro-trend run phase where price is so over bullish? Are we in the phase where we're having that impulsive move to the upside, that pro-trend run? Or are we in that counter-trend pullback phase, right? Where the higher time frames are pulling back? Because those phases, the pro-trend run or the pullback phase, they are made up of those price action on the lower time frames. Okay, so that higher time frame run is made up of lower time frame price action. And that lower time frame price action then forms the higher time frame candles and the market structure, which we can then use in our analysis to help us forecast that next higher time frame run. Right? So we're analyzing the higher time frames so we can forecast those large runs and trends, and then we drop down and analyze the lower time frames to not only help us to time our trade entries and exits with a lot more accuracy, but we also use them to confirm what may be happening on the higher time frames, right? So if we think the higher time frame is going to form that higher low and the higher time frame pullback is finished, we can look at the lower time frame to confirm that that pullback is over, right? Because we look for the lower time frame to switch trend. So this is essentially the secret sauce of how we achieve that holy grail, right? Of high reward to risk and high strike rate strategy, because you are combining all of the time frames together to have that deeper understanding of price action. Now, when we are mapping our structure on the charts, I would highly, highly, highly recommend that you use a set number of timeframes to do this. And the reason why is because, if you start flicking through an endless amount of different timeframes, you can just end up fitting the price action to the narrative that you want to see, and you'll most likely just end up getting thrown about by the market in the long run. So what I mean by that is, you might be just super bullish for whatever reason, and the structure and the time frame that you need to shift bullish first, it might not have broken the high that you need it to break, but then you might go and look at another time frame to show that it has broken a high, just because you're looking for an excuse to get into the market, right? So if you want the best possible chance of achieving consistent results in what is ultimately a random game, then you need to be consistent in the variables that you have personal control over. So I'll give you a general example that is based more on my own current personal trading style. So I use the daily time frame to give me my overall higher time frame perspective. Now, I will also look at the monthly and the weekly timeframes, but I'm only really looking at those once a week, really, as the price action on there and the market structure on those timeframes, they're not really going to be changing that often. So I don't really need to look at it really that frequently. Now, I will use the 4-hour time frame to give me my overall narrative. So that means building my story, really trying to build the story of price action. So once I've done that, I'll then drop down to the M15 to give me more of an immediate bias. So I'm essentially using the M15 to give me the direction that I want to be trading, intraday for that intraday session. And then finally, I'll drop down to the 1-minute time frame simply just to time my entries, right? So I'm doing all of the work on the daily, the 4-hour and the M15. I'm using my M15 for that immediate bias. And once I've seen everything that I need to see on the M15, it's only then that I drop down to the M1 at the very last minute, simply just as a timing mechanism and for a little bit more confirmation. Okay, so essentially, the way I use the daily time frame is to show me when is the 4-hour trend likely to turn around. So if the daily, let's say it's on a bullish run, so the daily is moving to the upside, and the daily breaks a daily high to form a higher high, what do we then expect? Well, we expect the daily to pull back, right? We're expecting the next phase to be the daily pullback phase. So if the daily is going to be pulling back and the daily is going to be moving to the downside, that then tells me that the 4-hour chart is likely to potentially switch bearish soon so that the daily chart can pull back, right? The lower time frame is going to change trend to facilitate that higher time frame pullback. But because I'm only expecting just the daily pullback, I then know that the 4-hour bearish trend, it's not likely to last very long, right? Like we looked at in the previous examples. Why is that 4-hour bearish trend not likely to last very long? Because it's just a daily pullback. So then when I analyze the daily and I think, okay, I think the daily's now pulled back to an area of value. I think the daily high low is likely to form. I then use that information to tell me that the 4-hour bearish trend is now more likely to end and the 4-hour is about to switch bullish so that the daily can continue its bullish pro trend run to make that daily higher high. Okay, hopefully you can visualize that without a diagram. That's essentially how I use the daily chart for market structure. It's mainly just to help me see when the 4-hour trend is likely to turn around, okay? Because I'm using the 4-hour trend a lot, I'm looking at it, but if I know the daily, what phase the daily is in, then I can anticipate when that 4-hour trend is likely to change, right? So when I'm looking at that 4-hour chart, I'm then essentially asking myself whether we are in the continuation phase or over in the counter trend pullback phase, just like we did the daily chart. And then that will determine how aggressive or how conservative I will be with my entries and with my management, right? Depending on whether I will be trading against the 4-hour trend or whether I'm trading with it. And then I will use the M15 to give me confirmation of when the 4-hour continuation phase may be ending and the counter trend pullback may be starting, right? And vice versa. So the M15 trend essentially can help you to spot when the 4-hour pullback may be starting or ending, right? And then finally, the 1-minute time frame, and sometimes lower, that is then used for the last extra bit of timing to confirm those turning points in the M15. And this is where I'll look for my entry models. Okay, so the 4-hour and the M15 for me personally, at least at the time of recording, those two timeframes alone are probably where I spend over 95% of the time looking at analyzing when I'm on the charts and looking at the market. Okay, this is, if you make a note of this, this is the mistake I see most often with people who are losing, or at least initially, is that they have their M1 time frame open or whatever time frame they use for entries, and they're looking at it all the time, and they get trapped into taking so many poor and average trades because all of your work should be done on the higher time frames. Like for me, that'd be the M15 and above, and I literally only open the M1 chart or look at it at that very last literally minute when I've seen everything I need to see. It's in my M15 area of value, and I'm just using it as a timing mechanism. Okay, so I'll only drop down to that at the very, very end. If you're going to be sitting on that one chart all day, you're going to be seeing tens, if not hundreds of entries a week, and you're literally just going to get stepped around by the market. And you're going to be wondering why trades aren't working out or why they're turning around straight away. And the M1's going to be changing trend every few minutes. So that's why we build the higher time frame narrative, because it's the higher time frame moves, those higher time frame runs and pullbacks. It's those higher time frame phases that I'm interested in trading, because that's where the high reward to risk is. I'm just solely using the M1 for increased refinement to get a tight entry and stop loss, but also to give me that extra piece of confirmation to make sure as many timeframes as possible are in sync and confirming what I think I'm seeing, right? So I'm trying to really drive this point home, okay? So for me personally, the 4 and the M15 are the most important timeframes when it comes to market structure. In very, very simple terms, let's simplify it even more. The 4-hour gives me my higher time frame bias. The M15 shows me my intraday direction that I want to be trading in, and then the M1 just helps me to time it, okay? Now we'll get into all of this in even more detail as we go through the rest of the lessons, but specifically in the trade plan module, we'll discuss the different timeframes and the criteria that you may personally want to use for each of those timeframes, depending on your own style, your own trading personality, and your own lifestyle constraints. For instance, if you wanted a slightly more longer term perspective, potentially if you have a full-time job where you can't actively monitor the charts on the very low timeframes, or maybe your psychology just isn't really suited to day trading, right? You can just shift all of those timeframes here up a level, right? So for the higher time frame perspective, use the weekly chart instead of the daily chart. Use the daily chart for your narrative. So seeing if you're trading a daily pullback or the pro trend run, use the 4-hour chart to give you your immediate bias of the direction that you actually want to trade in, and then use the M15 as your lower time frame execution. The market's fractal, right? You can use those timeframes, just shift them up or shift them down to suit you, right? So, make sure that you utilize multiple timeframes to know the higher time frame narrative, actively monitor the lower time frame price action, and allow the trade setup to present itself. Okay, so in the next lesson, we're going to hop on the charts and actually apply all of this theory to real world market examples. But before we do that in a minute, I just want to end this lesson on just one last example to make this really important point hopefully start to sink in. So when we're in a 4-hour bearish trend, the expectation is that that expectational order flow is for the 4-hour to keep forming lower lows and lower highs, right? That's what we are anticipating until proven otherwise. But as we now know, in order for the 4-hour to create a new 4-hour lower high, what do we need to see? Well, it's very likely that the lower timeframes will form a bullish trend to facilitate that 4-hour pullback, right? So we will first see that shift in order flow in the lower timeframes to switch bullish, to then signal that the 4-hour chart is pulling back to form that potential 4-hour lower high. So when price eventually pulls back and when it returns to our previous 4-hour lower high, right, the strong 4-hour high at this moment, because the 4-hour is bearish and it's a strong 4-hour high, our expectation is that the price will now sell off and continue that 4-hour bearish trend, right? However, it does not have to. Remember, anything can happen in the markets, right? Anything. So as price develops around this area, our mission is to observe its development and listen to what the market is telling us in a neutral state of mind. All right, so what does that mean? Well, the lower time frame structural development within those higher time frame points of interest, that is what helps guide us to be in the flow of the market and to execute accordingly and to be essentially in harmony with the market. Now, I know sometimes it can be a little bit confusing because on the one hand, I'm saying that we're supposed to be completely neutral in the market, but then on the other hand, at the same time, we do have to have some form of bias, right? We have to have that expectation of order flow. So surely these two things are contradictory, right? How can you be neutral, but also have a directional bias and an expectation of the direction of order flow? Well, this is essentially how you do it. You understand what is the more probable situation, but you're not attached to that outcome having to happen. You don't care either way, right? We let the market show us the way and we adapt to what it shows us. So all of the technical analysis tools and concepts that we use are simply a mechanical framework to help guide us through the order flow of the market. So as Bruce Lee says, be like water, my friends. Flow with whatever way the market wants to go, that the lower timeframes give you the confirmation to show you the higher timeframes' true intentions. Don't fight the market from within with your own bias and attachments. Master it from above.